nights. Call now for your free week supply of Alteril.
There's a mustard seed in the commercial real estate crisis. CNBC's Diana Olick joins us now with the details. Diana?
Well, Jerry, the big question is, can government save commercial real estate from its fundamental ills? Well, probably not. But it can revive commercial lending, which, of course, is a huge part of growth in the sector. Now, commercial real estate did not see the vast overbuilding that we saw in residential, so supply and demand were actually healthy before the credit crash. It's all about financing now, as over $500 billion in commercial debt comes due this year and next. That's why the Fed's announcement this week that it would use the TALF to buy not just new, but legacy CMBS was a big shot in the arm for commercial.
The market died in October, and it is now coming back to life. And I think the markets perhaps are overreacting a little bit. I think in talking to our clients that there is still a lot of uncertainty, but I think there is hope.
Clearly hope as investors rush in to buy. Spreads just a few weeks ago were over 1,000 basis points. Now they're down to around 565. That means banks will have more cash to lend. But we are not out of the woods yet for sure, with vacancies still rising. Critics say the TALF is creating a misplaced euphoria. Commercial values could still plummet 30 to 50%, some say, and that would create a wave of default. So many of these properties, the problem is that they are so far underwater on their loans due to these falling property values that when they come up to refinance, they simply can't get a bank to lend them the money they need. That is one of the biggest problems still out there. Rebecca?
Thank you so much, Diana. And commercial real estate isn't the only mustard seed being planted this spring, and the most unlikely economist of the bunch is taking note. The usually bearish Nobel Prize winner Paul Krugman has turned bullish. He says just about all the economic indicators out there are suggesting that the free fall has come to an end and that we have stabilized, and probably the worst in terms of shocks to the system is over. Now, in a bit of a twist, former Fed Chair Alan Greenspan is now the dour one. Listen to what he had to say yesterday. There is still a very large unfunded capital requirement in the commercial banking system in the United States, and that's got to be funded. And until the price of homes flattens out, we still have a very serious potential mortgage crisis. So who has the story right, Krugman or Greenspan? We're back with Michael Oznanian, David Dietz, and Michael Pinto. And Mike, oh, I feel bad because you just get left out sitting here next to me. Want to kick things off with you. First of all, here's my question. Was the problem up front overstated if it's healing itself this quickly?
Well, no, I think things are getting better. I think the Fed botched this with the Treasury from the beginning. They should have used TARP to buy the troubled assets, which they've never done. They haven't bought a dime's worth. And I think that put us behind the curve. And I think the biggest problem, again, I hate keep agreeing with Mike, you know, because we're not on that often. But the biggest problem right now, as far as the economy is concerned, is two things. Too much government intervention and a debasing of our currency. That said, I'm still bullish on equities. I think they've got a long way to go up.
Interesting. By the way, I'm bullish too. But is Alan Greenspan, this is a jump ball for anyone, is Alan Greenspan really a man with credibility to talk about the crisis that we're in now?
None.
The guy
Zero. He caused this with easy money policy during his administration. He was the one who caused the housing problem and the mess we're in today. He's the culprit.
So if there's a takeaway from that, if we can call him the culprit, then is regulation, is what the lawmakers do going forward going to make an impact in terms of 100% impact?
We had all the regulation we need under a gold standard, but that was abrogated in 1971. But let me ask you a question. I don't understand something here. We've lost 6 million jobs since the recession began. Home prices are down 31%, and the Dow has lost 33% of its value. So all the debt that we have as a consumer and as a nation remains, and the debt as a nation is skyrocketing. So when the Fed ever gets around to raising interest rates, the economy is going to collapse just as it did in the last year.
Is some of the trick then, Mike P., to when they get around to raising interest rates, or is that
they have to.
To the debate?
Don't they have to? Don't they have to fight
at some point.
Don't they have to defend the currency at some point?
Is there a period of time?
Shouldn't they have been doing it all along? Aren't they too low? They're too low, right? Where would you want them?
Zero.
Where would you want them?
I would like them to put interest rates, say, 4%.
Double D wants to jump in.
On the Fed funds rate.
The big issue really is to get America back to work. And the way you do that is actually to have a weaker currency, because that puts American goods on sale. We need a little bit of inflation to stabilize.
Wait. How are American goods on sale if we
print money and create inflation?
Well, if the dollar goes down, as Michael P. is suggesting, then that makes it
then the dollar's on sale,
you have to
and then everything denominated in the dollars is not on sale, so it can't. You cannot devalue your way into exporting.
Well, a little bit you can. Absolutely.
I don't think you get it all. I'll tell you what you do. What you do is you tell the world, don't invest in American assets, because even though you might make money on your investment, you'll lose money on the currency transaction. Stable dollar. Doesn't have to be gold, by the way.
Well, it certainly sounds like
gold standard in 29. We had gold standard in 1837.
In this discussion, China has certainly become the main customer of the United States. They have been our consumer. They consume our debt. The question going forward is, can this reflation trade, if it helps build at least people's mind and confidence in the stock market? Let's just say for a minute, play devil's advocate here and say it doesn't hit people at the pump. It doesn't necessarily hit them at the consumer level. Well, it is, but it's definitely less. I mean, right now, if you're paying $2.50 a gallon, you were paying $1.50 more than that last year this time going into the season. So the question is, let's just say we reflate our portfolios enough to make people's psyches, psychologically speaking, more positive.
Don't you want to get a real return? That's the whole goal of investment.
Everybody wants to get that.
After-tax real return. If your portfolio is going up in nominal terms, that shouldn't matter to anybody.
We've gotten a nice real return over the last 9 weeks, and I think this reflation has boosted consumer confidence. We've seen that in the figures. In fact, we're even starting to see a little bit of stabilization in home real estate values, where more sales
not in value.
Some of the hardest hit areas.
Inflation has resurrected the banks, and I think that's the main thing. I don't like inflation. I don't like deflation. I like, what do we have right now? 0% inflation is what we have.
Last word goes to the most patient man in the room.
Ultimately, the bond market's going to be king, and if the long-term yield continues to rise as it did today, then we're going to get to what Michael was pointing out, which is the Fed's going to have to put its foot on the brakes quicker.
But they're talking about buying more of these coupons.
And it depends why it's rising.
That's a scary
If it's rising because people are rotating out into the stock market, into riskier assets, that's exactly what we want.
But the thing that's eased credit right now is you've had the Fed's fund rate, what the banks have been lending to each other, and the yield narrow. That's helped ease credit. If that starts to widen again, that's going to throw everything that we've been trying to do.
The question to go out on, just real quick answer. When should they hike? When should they tighten? How long? Give me months. How many months? How many months from now?
I can't tell you that because I don't know what they're doing on a day-to-day basis.
About a year ago.
All right. Negative 12. How many months?
I think in 12 months. In 12 months.
All right. We got a nice little band there. All right. Thank you so much, Mike Azanian, Michael Pinto, and David Dietz. Up next, Washington is coming down hard on credit card companies, but will new rules to protect consumers backfire on business and the economy? We will be debating that. You are watching